Hello, this is Dr. Adam J. Bach. In this audio presentation, we'll begin our conversation about private capital funding for technology ventures, which will then lead us to a further discussion about pitch decks and negotiating a deal. So to begin with, we're going to cover a couple of topics. Why investors and entrepreneurs often don't agree about the funding round. Your textbook provides a detailed explanation of funding and valuation based on option value analysis. That's quite beyond the level of sophistication in this particular course, so you are welcome to completely ignore that. We'll quickly cover types of capital and types of investors. Then again, your textbook goes into a detailed explanation of discounted cash flow valuation. You also don't need to know the detailed information about the LinkedIn S1 document that's provided in the textbook. However, both those are useful areas to skim just so you're familiar with them. Discounted cash flow analysis in general is a very standard business tool. Even if you don't fully understand it or know how to use it, you should be aware that it's out there. The basic concept being that cash in the future is not as valuable as cash today. And because almost all aspects of financial planning and managerial decision making are driven by this type of analysis in one form or another. And then I'm going to provide you with a little bit of background on valuation and prepare you for the Canvas activity, which will walk you through a couple of valuation analyses, or really funding analyses, to look at ownership and dilution, and then that should give you some good ideas, a much better understanding of the investment capital process. So we want to begin with just pointing out that investors and entrepreneurs very often do not see eye to eye about the funding process. Entrepreneurs are under the impression that their technology venture is spectacular and people would be foolish not to invest in it, and yet for some reason investors often don't see it that way. It's very common for entrepreneurs to speak to 5, 10, 20 or even more investors before finding a single person who says, yes, I might be interested in this. It's very common to hear stories from entrepreneurs who say, I got 25 no's before I got yes. And there are a number of reasons for that. The projected outcomes are very uncertain. The entrepreneur tends to believe they're pretty much a fact, and the investors assume that they're pretty much speculation. There's usually a tremendous amount of asymmetrical information. The entrepreneurs have a lot of knowledge and information about their venture that the investors may not be very familiar with, and the investors have a lot of information about the venture capital process and broader market conditions that the entrepreneurs might not be familiar with. It's quite challenging to assign value to intangible intellectual properties. How much is a patent worth? It's a great question. There's no definitive market for patents. The dynamics of the industry and the current financial marketplace are often huge determinants of how valuable a company is. That's often very frustrating to entrepreneurs who believe that their venture opportunity should be considered pretty much in a vacuum without consideration to what the market looks like. And then the final element that's mentioned in your book is that the entrepreneur's wealth tends to be concentrated in the venture, and that drives their decision making, whereas investors are focused on having a diversified portfolio and they have lots of other opportunities available to them. For the entrepreneurs, the deal is everything, and for the investors, it's just one of many possible deals. I also think it's useful to point out that when entrepreneurs or investors sit down at the table, they're very often at the table for totally different reasons. The entrepreneurs are usually there because they want to change the world, and the investors are there to make money. And now these things are not incompatible, but it is very often useful to recognize this distinction when you're approaching the negotiating process. So let's talk about just briefly the two different types of external capital. They are debt and equity, and these should be pretty straightforward and familiar to you. Debt is a loan. Equity is an ownership stake in a business. Debt comes from banks very often, but it can come from any lender. If you borrow money from a friend or a family member, that's debt. Debt is usually used for stable investments, lower risk tolerance. There's usually a fixed sum of money for a period of time at a certain interest rate, maybe 10% or 20%, whatever it happens to be. Investors have limited upside. Their goal is to get the repayment of all the interest and the repayment of the principal, and then that's pretty much it. That's why, in general, lenders prefer to have low levels of uncertainty. On the other hand, they do get first claim to assets upon bankruptcy. This is usually quite a surprise to entrepreneurs to learn this. In the United States legal system, if a company goes bankrupt, the debt holders get the money out first. And this is why debt is a less risky investment. Entrepreneurs are often under the impression that debt is a more risky investment from their perspective because they have to pay interest on an ongoing basis. But that's exactly the wrong way to look at this. Possible interest rates for corporate debt are shown. This is why it's usually not possible to fund a startup company with a significant amount of debt, because the interest rates don't match the actual risk of the venture. Equity can come from a variety of sources: friends and family, angels, VCs. Equity is ownership, voting control, and it also gets you a part of the profits. And that's why there's potentially unlimited upside. Owners participate in profits, and if there's an exit, then they get their proportionate share of whatever that exit value is. This is a higher risk level because there's the assumption is you can lose the full value of the principal. If the company goes bankrupt, you're behind the debt holders to get anything out of it. So there's a lot more uncertainty associated with these kinds of investments, and very often the expected return rate, even if it's not explicit, can be as high as 50% or 75% per year, or even higher. Basically, investors are charging a price for bearing risk. And the way they manage that risk is usually by investing in sectors that they're experts in. So it's really important to recognize this crucial distinction between these two types of investments and don't confuse them about which one is riskier. Where do tech ventures tend to find capital? Your book provides a lengthy set of possible sources of funding. These are not all available to any venture. For example, most ventures will not get government grants. The vast majority of companies do not go public. But the standard mechanisms are founders, family, and friends. Crowdfunding has become a lot more popular. You should be familiar with that particular platform for raising funds. It's described in your textbook. There are investment companies that make investments in small businesses. There are grants. Angels and venture capitalists are the classic form of private equity. And then there are a variety of other mechanisms that ventures can use to find capital. A good one to note here is customer prepayments. This is a form of bootstrapping where you get your customers to pay for a product in part or in whole in advance. Pension funds and insurance companies are very unusual funding mechanisms for tech ventures, usually only at a very late stage, or if they invest through a venture capital firm. So just to provide you with a simple summary of the general stages, these numbers are based kind of on Wisconsin. If you went out to California, you'd find that the quantities are much larger. A seed stage funding in California might be $1 million or even $2 million, and a first stage or Series A investment might be $5 or $10 million or even significantly more. My point here is simply to show you that there's a difference in how ventures are funded over time, and to give you a rough sense of what they use the capital for and what the likely rate of return expectation is for the investors. So once you've used up whatever friends, family, and fools that are available to you to raise usually small amounts of money, there are then other funders out there, individual angels, venture capital firms, and then in some situations, strategic partners, corporations in the form of either a partnership or a corporate venturing activity. You need to remember a couple of things. There's 600,000 new corporate entity filings in the United States every year, and there's less than 200 IPOs. So you need to keep in mind that IPO is not a reasonable goal to put in your business plan. Venture capitalists and savvy angels will look at that and realize you don't really know what you're talking about. Keep in mind that less than 1% of all new entities get institutional venture capital. That's just the reality. If you're going to get a venture capital, you basically are saying that you can grow your firm to about $50 million in 3 to 5 years. If your firm doesn't have that potential, then you shouldn't be talking to venture capitalists in the first place. Keep in mind that 90% of all new ventures are funded with founder cash, credit card debt, money from fans and family and friends, and bootstrapping. If you are headed down the private equity route, you'll probably end up talking to angels and VCs. Your book talks about them in a little more detail. You really just need to understand that there's a pretty clear distinction between how these operate. Angels are using their own personal individual funds, their own money, and they're making the decisions themselves. And while many angels are quite sophisticated and make decisions based on careful analysis and some quantitative analysis, very often angels are making investments based on emotions or their gut, and in particular they're usually making the investment based heavily on the team and something about the technology or the application that they find interesting. Their oversight varies. Some are very active, some are very passive and just let you run your business. These investment deals tend to be less complicated. A venture capital firm is a managed fund. They raise money from wealthy individuals and other firms, pension funds, and so on. And then they pool all that money and they deploy that through a standardized investment process in which they look at many deals. They make then one decision. So when you get an investment from a VC, you're getting one decision that then controls a significant amount of money. Whereas with angels, each angel is making their own decision. VCs tend to have very active oversight. They usually demand a board seat and often a lot of protective clauses in your deal, explanations for what happens if you miss a milestone, voting control, and things like that. Very often entrepreneurs are under the impression that venture capitalists are evil. They have the nickname of vulture capitalists. The reality is that when venture capitalists are actively engaged in a deal, they can be incredibly helpful. They have extensive connections. They can secure long-term funding. They can help bring competent people on board. But you need to remember that they're doing this as a business. They're managing other people's money. And so when things begin to go bad at a given investment, very often their goal is to figure out if they think it's going to work or not. And if it's not going to work, then they want to shut it down as fast as possible, get whatever capital they can out of it, and then move on to something else. Remember, it's just one deal out of an entire portfolio for them. So it's not that they are good or bad. Obviously, individual VCs some are nicer than others, and some are more professional and more capable than others. But the bottom line is they have a job to do, and you need to remember that a lot of their decision making is going to be based out of the fact that they are managing other people's money. At the same time, getting venture capital money is just the start of a long journey. There are many entrepreneurs who are under the impression that once they raise venture capital, everything is pretty much done, and you just have to kind of ride it out from there. And the reality is that when you look at how many deals there were, and how few of those deals then go to IPO, you realize there's just an enormous amount of work that has to get done. And even in the deals that get done, the majority of venture capital funded deals don't succeed. The majority of them are either total losses or return only a small portion of the amount that was originally invested. So getting venture capital is an important step for firms that need to scale up very, very rapidly, but it is not a guarantee of success. So you might be asking, why are there so many different types of capital? I mean, why are there corporate debt? Why are there angel money? Why is there SBIR grants? Why not just fund every company exactly the same way? And the answer is because it's all about risk and reward. The higher the risk, the higher the potential reward that's required to attract investors. And not all of these investment products have the same risk-reward profile. So debt has a lower risk and lower reward profile. Equity has a higher risk, higher reward profile. So if you think about it, the whole point of going through these funding rounds is to de-risk the business. You take money from a high-risk investor who's expecting a very high reward, and you accomplish something. And by accomplishing something, such as getting your first sale, or doing a proof of concept test, or finding a strategic partner, you de-risk the business. You show that the chance of success has gone up. And that then allows you to go and try to raise money from an investor with a lower risk-reward profile. Because then if you can do that, that investor is expecting lower rewards, which means you can retain more of the rewards for yourself. This is why banks finance house purchases, but not startup companies. A bank has an extremely low risk-reward profile. It wants to take minimal risks, and it's willing to accept modest rewards for that. A house has all sorts of advantages to it. You know exactly where it is, and you can get an awfully good sense of how much it's worth at any given time. And, even better, if you unexpectedly end up owning the house, you can turn around and sell it on a well-developed market. And so all of those factors make it possible for banks to do mortgages, to loan money for home purchases. But they won't loan money to a startup company for exactly the same reasons. It's very hard to assess the stage that it's at. It's nearly impossible to assess how much it's actually worth. And in the unfortunate situation in which a bank became the owner of a startup company, it could be impossible to run or sell. So all of that makes banks funding startup companies pretty much an impossibility. The challenge in financing events is always valuation. And I'd love to tell you that there was a simple formula that you could use to value every startup company. And your textbook may unintentionally give you the impression that it's pretty straightforward to value a startup company. But in reality, valuation is both a science and an art. A startup company that has some patents and maybe some initial thoughts on customers and maybe a product prototype, but has no revenue, it has no operating history, and so valuing that kind of a venture is quite challenging. Most of these depend on rules of thumb and comparables. Were there any companies like this that got funded in the past? There are ways to look forward to future funding. If you know that companies like this tend to get a Series A that tends to be about $5 million, worth about 25% ownership, then you can sort of bring that back to the present and say, well, if that's where we're headed, we can roughly estimate, what kind of valuation we would expect for the business right now. You can try to do a discounted cash flow analysis, but the problem with those is that the discount rate that you use might be just complete guesswork. Traditional discount rates for corporate America tend to be between 10 and 20%, but that's clearly wrong for a startup company. When I've done discounted cash flow analyses for startup companies, we've often used discount rates as high as 40%, 60%, 80%, or even 100%. And ultimately, it comes down to what investors will pay, which is going to be driven very significantly by market conditions, which the company has zero control over whatsoever. So if the market is up, the broader stock market and the M&A market and IPO market, if those are all up, then investors may be willing to pay more for their ownership in a startup company. And if market conditions are bad because the stock market is down or there hasn't been a lot of M&A activity, then investors might not be willing to pay so much for a startup company. And that's completely out of the control of the founder, which is often a very disappointing experience. Venture capitalists will use very sophisticated valuation models, but keep in mind that even once they go through that model, everything gets negotiated anyway. All the moving parts, such as the equity pool, whether the investment's tranched, that is, done in steps, what the milestones look like, and so on and so forth. So, having listened to all of this, you're going to do an activity that's going to take a little bit of time in Canvas. You're going to walk through two valuation processes, a simple one and a more complex one. And these are the things you're going to want to keep in mind. Post-money valuation is always equal to pre-money valuation plus the invested capital. Pretty straightforward. Whatever the company was worth before the investment plus the cash that goes in is the new valuation. When someone puts money into a startup company, their ownership percent of their new investment is equal to the amount of money they invested divided by the post-money valuation. So how much you put in divided by how much the company is worth at the end of that investment activity. And then in order to think a little bit about dilutive effects, that is, what happens to people who previously invested, the ownership percent for prior investment is equal to that percent times 1 minus the new investment percent. So in order to figure out what happens to prior investors, you have to take into account how much they gave away in the new round of funding. One way to think about this is to do a short example. Imagine for a moment that you have made an investment in a startup company and you gave $10 to the company and you now own 50% of the company. So obviously this company must be worth about $20 since you own half of it and your piece was you paid $10 for it. So let's imagine that nothing else changes here and the company is still worth about $10. But it needs $10 more. So it goes out and it finds another investor. And that investor puts $10 in, and they get 50% of the company at this point as well. So what's happened to your stake? Well, since the new investor got 50% ownership for their $10, the value of the company is still only $20. But you don't own half anymore. You used to own half. To figure out how much you own now, you take your percentage from before, which was 50%, and you multiply that by 1 minus how much of the company the new investor got. Well, the new investor got 50%, so 1 minus 50% is 50%. So then we multiply that by your 50% that you earned, that you had previously. 50% times 50% is 25%. And so your ownership stake is now only 25% of the company. So this was not a particularly good situation for you. There must have been some kind of problem that the company needed to go out and raise more money at the exact same valuation. The goal, of course, is that the valuations continually go up, because then even though your stake is smaller, your ownership is worth more. So I think this will become more clear as you go through the two examples. The first one is simple. The second one gets a little more complicated. These are the kinds of things I might ask on an exam or in a quiz, and so you're going to want to go through these and make sure you understand them. The good news is you can take this quiz as many times as you want, and you can stop it at any time and start over. And there's detailed explanations provided, giving you hints and information, and in fact the actual answers as you go along. So I hope this gives you a good introduction to this, what is in many ways a very complex topic, and I think the Canvas activity will provide a lot of assistance in helping you see what the actual mechanics and mathematics look like.